Welcome back. Let's talk about the banking space now. Two circulars from the Reserve Bank of India. One, of course, on the expected credit loss provisioning norms effective FY28. The second one, of course, risk weight modification across asset classes. Let's take this forward with two experts in the field. Harsh Vardhan is Senior Advisor at Bain & Company. Anil Gupta, Senior Vice President and Co-Group Head, Financial Sector Ratings at ICRA. Gentlemen, great to have both of you here. Harsh, good to have you back with us. We spoke that Friday, of course, on the day of the RBI, the MPC, that afternoon. So let's just take it one by one. On the ECL provisioning norms, the circular which has come through, it's gradual implementation, right? So negligible impact on capital ratios?
Yeah, for now. And I think even when the first discussion paper came on ECL a few years ago, RBI had clearly indicated that there will be a smooth glide path. Remember, this is not an incremental change. This is a paradigm shift. This is a very, very fundamental change. And I think the RBI is doing the right way. Because if you do it in a jerky manner, then there would be a capital shock. So what effectively RBI is doing in the way it has approached it is to smoothen the impact on capital and on earning to be spread over a few years, so that the movement for the banks is going to be smoother. So that's how I see it.
Some upfront earnings impact?
It will vary across banks, Prashant, and it depends really on what the current status of banks in terms of their standard asset provisioning is. So there may be some impact on some banks, but there will be some banks on which there will be negligible impact. So this would vary somewhat across the banking sector, but I would say overall on impact on the banking sector, the way these norms have been described and the way the transition has been described would be somewhat muted.
Got that. Anil, your first thoughts on the ECL circular?
So our thoughts are basically no negative surprises. What we were more concerned was basically the floor or the regulatory floor which will possibly come on stage 1, stage 2 and stage 3 assets. Will the regulatory floor be maybe a higher number which could entail higher transition provisions? So largely the floors are not maybe something like prohibitive. They are maybe comfortable level, while they will still have an impact on the reported capital ratios, but the floor is okay. For example, like say the stage 1 floor has been kept at maybe 0.25 to 0.4% for most of the retail loans and maybe secured loans. So that is something which is a positive or no negative surprise, because banks generally have this 0.4% on the standard assets. Even for the stage 2, I think 5% or maybe 1.5% on home loans is fine, not a high number. Otherwise, it would have kicked in a higher ECL requirement.
So I mean, and ratings is a key criteria for all of this. No sort of extreme risks for corporates in the medium term.
So for the corporates, I think the proposed changes in the risk weight which will be applicable, right, for the various rating categories, that will only be beneficial. So maybe in terms of provisioning because of ECL, no negative thing again. But from the risk weight perspective, that changes are beneficial because let's say even a AA rated loan will have a 20% risk weight as against 30% earlier, or a BBB rated loan will have a 75% risk weight as against 100% earlier. So it's beneficial for corporate.
On stage 3 to stage 2 and then after 60 days moving to stage 1, what's the current behavior like? Any sense on how many borrowers kind of fall back into NPAs again?
So the rollback rates will depend on the asset classes. Generally, we don't find too many corporate loans as of now in the stage 2 bucket. So maybe SMA 1 and SMA 2, which will be classified as stage 2 now. If you look at most of the banks, typically the stage 2 for corporate loans will be in the range of 0.2, 0.3%. Largely today, that stage 2 is more constituted by the retail loans, where the ECL provision will kick in. That could be a number anywhere between 2 to 5% across maybe banks of their loan book.
Got it. Anil, how are credit costs going to move according to you? Will there be some impact? Private versus PSU?
So credit cost in terms of maybe, see what we can look at is we are there is FY26 and FY27. banks can choose to make some kind of a provision, floating provision, contingent provision in a run up to the implementation on 1st April 2027.
Okay.
So one, you can either create those provisions and not have a one-time impact on your capital ratio on 1st April 2027. Or you can build up your capital and take a one-time knock on 1st April 2027. So one-time knock means maybe on a without any forbearance. So we do think that some banks will maybe create a provision in a run-up to 1st April 27, which could have some impact on the credit cost. But again, largely they have strong P&L which can take care of that floating provisions, contingent provisions. But maybe on 1st April, it will be a balance sheet entry most likely, where whatever is the ECL transition provision, that will be basically removed from your net worth or your core equity capital, rather than have an impact on a P&L, one-time impact on the P&L.
Okay. Harsh, on risk weights, right? What? So there's residential mortgages. As Anil mentioned, BBB rated corporates, commercial real estate. What stands out to you?
Yeah, so two areas. One is residential mortgages, but also MSMEs, where the definition has been widened. MSMEs that will be treated under retail category to group revenue of 500 crore. So those are the major ones. The BBB going to 75 is interesting because a large percentage of our Indian banking sector portfolio is in BBB. And I think that would actually have an impact on bringing down cost of credit to a large, sizable amount of companies if banks decide to pass that on, the lower capital requirement. But can I make a couple of comments on the previous point on the floor?
Sure. Go ahead, Harsh.
The floor is the important. See, look, the biggest change is going to happen in stage 2 because that's where the provisioning floor is 5%. And that is what varies across banks. You know, how much do you have in stage 2, sorry. My own view, Prashant, is that the stage 1 floor especially are a bit lower than what I would have expected. Essentially, RBI has kept it at where the current standard asset provisioning is, which means, although I don't think, given the general spread of portfolio of Indian banks, 0.4, 0.25 floor is adequate. So what might happen over a period of time as the system stabilizes, the floor on stage 1 might increase. That's my expectation as more data sort of starts coming in. I think this is also part of the RBI kind of providing a glide path, not creating a jerky movement into the expected credit loss based provisioning. And therefore, what will happen between now and then? I think the reduction in the risk weight is also part of that glide path because, as Anil was saying, that banks could actually do one of two things: raise additional capital or create additional provisioning buffer between now and 27 when it kicks in. So that at the bank level also the impact becomes a bit muted. So I think that's the way I see it.
No, very, very interesting points. Anil, you want to comment on the risk weight bit? What kind of stood out to you?
Yeah, I think favorable changes in the risk weight. Overall, basically one negative impact on capital because of ECL and maybe a positive impact on the capital because of risk weight, lower risk weights. Overall, it should be negative on the capital, though the impact will be muted because of these risk weight changes. But maybe few things on the risk weight changes which we found to be maybe interesting was maybe a 75% risk weight on a BBB rated loan, which has been brought down. But generally, we map long-term ratings and short-term ratings. So on a short-term scale, BBB rating category will typically map to A3, on which the risk weight has been kept at 100%, not 75. So if a same corporate is rated BBB on a long-term and A3 on short-term, so different risk weights will be applicable, 75 and 100. So maybe that's some clarity may be required in the final, maybe whenever regulations come. And one interesting thing which has come this time on the risk weight is the regulator has linked the risk weights based on the default rates of the various rating agencies. So if a rating agency has higher default rates, then the next category of the risk weight applies, or higher risk weight applies, just because the rating agency has a higher default rate. So this is, I think, a really interesting move. We have to see how this pans out because, again, here, this default rates, we will need the clarity that whether short-term default rates will apply or a long-term default rates will apply, because we publish 1-year default rates for 2 years, which is short-term, and 10 years, which is long-term. So which default rates will apply for calculating the risk weights. That is something which will wait for clarity in the final regulation.
In a way, rating agencies themselves being rated.
In fact, Chan, if I may quickly add, there is a increased scrutiny of rating agencies. There is a standardization of default. There is disclosure requirements on PDs, which was earlier not there for bank loan, it is there for bonds. So I think RBI has also addressed the governance issues around ECL, both at the level of the bank, but at the level of rating agencies as well.
Oh, it's very, very interesting. And I think these are points where we needed a little more time. We're coming to it at the end of our conversation. I have to sort of say thank you, but we'll sort of continue talking about this on other platforms. Thanks very much, Harsh and Anil, for joining us with that quick take on these two areas, the ECL and the risk weight circulars from the Reserve Bank of India. Well, it's a wrap on this edition of Bazaar. Chartbusters up next. Stay with us.